With every rate hike, a homeowner's holding power does get weaker if they're on variable rates. Now, it might be possible to stick it through for a few months and stretch yourself, but since nobody really knows how much more the Bank of Canada has to go or how long rates will stay high for, it might even be tougher to figure out if this is actually sustainable for you. So now you might be seriously looking at options while you can still have them. And so in this video, we'll try to weigh these options with you, and hopefully this will help you make more informed decisions as a real estate investor. Let's get started. We're in a high interest rate environment today, but there are definitely deals on the market that still make sense. Prices have come down from the peak and rents have skyrocketed, and both of these have helped to combat the much higher interest rates that we are experiencing today. The main issue with holding power for existing homeowners is that they're not getting market rents, and this is why it is a lot harder to service their much higher debt obligations today. Selling is obviously an option, but before you do that, consider if there are ways to improve your holding power first. Now, the first thing to look at are your own cap rates and whether they're significantly lower than market cap rates. How you should be calculating cap rate is by dividing your rents that you get less your operating expenses by the market value, not the purchase price of your home. If you are getting lower than market cap rates, here are a few things that you might want to consider. The Ontario guidelines do allow you to increase rents by a maximum of 2.5% this year and next year. But there could be a possibility that you can get a bit more than that if your costs went up significantly. One allowance cost increase that does let you increase rates by more than 2.5% are current Toronto property taxes. Now, here's an example. If your current lease's first rent increase happened in 2020 when the guideline increase was at 2.2%, an extraordinary increase would be 50% more than that, or 3.3%. This year, property taxes went up by 5.5%, and so most people would be able to increase rents by more than 2.5% if you're in Toronto. Note that the maximum increase that you are allowed to increase by above the guideline is 3%. And so what this means is that you would be limited to 5.5%, which might still not be enough to help you cover all of your costs. And so a more effective way to improve rents more substantially would be to split your house into more units if that is possible. The benefit here is threefold. Number one, a house with more units generally give you better rent yields compared to less units. And number two, you'll refresh your rents to market rents when you do this. And number three, you'll be able to track market rents much better moving forward because new units created after 2018 won't be subject to rent controls, which is huge. And so we definitely do recommend you looking into this if you are allowed to do this and you do have the capital to get this done. Now, if adding units isn't an option for you and you do have extra savings, it might be time to consider deleveraging to reduce your monthly mortgage payments. The math here is pretty simple, actually. If you have some money sitting in a GIC generating 5.5%, then that does look great, but actually doesn't make sense if you're paying 6% on your interest on your mortgage on the other side. So definitely think about paying down your loan to improve your cash flows and your total returns as a portfolio. But if you don't have the power still to hang on after exploring ways to improve your cash flows for at least the next year and a half, then the reality is that you might actually have to think about selling your investment. Selling when you don't want to obviously isn't ideal. What you'll lose out on for sure are selling fees, legal fees, land transfer taxes that you paid for when you bought the property, and potentially be hit with capital losses because you're selling in a down market. However, if you're not just selling, but you can actually reposition your money into a better long-term investment, it could still be a decent move. For example, let's say you're sitting on a couple of condo investments. Even if you optimize market rent yields, there's no way it could be high enough to pay for today's higher borrowing costs. So, what could make a lot of sense is if you are able to consolidate a couple of condos into a single, better yielding real estate investment, which most likely has better growth prospects too moving forward. And this time, think defensively when you're choosing your new investments. Number one, choose stronger rent yields. A single family house is better than a condo, 2 units is better than that, and 3, 4, or 5 units is even better. Toronto houses definitely stand out in Ontario since you have the potential to create up to 4 units in the main house plus the backyard house, so that's a total of 5 units compared to other areas in Ontario that might only allow 3 units in total. Number 2, we talked about the importance of being able to track market rents. When interest rates go up, market rents also go up, so that definitely helps you improve your holding power. And besides holding power, it also helps your property value too, because homes end up selling at a discount when rents are low. Now, this is all only possible if you have new units built after November of 2018. And so even though creating new units in a house is a lot more work and more money, in our opinion, it is worth it if this is an option for you. And 3, finally, repositioning is definitely different from just selling. When you sell and buy, you sell at a lower price because of the market, but then you also buy at a lower price because of the market. So essentially, you're deferring your capital gains to your next purchase. Less money taxed away means more funds for your next investment, which could mean that you end up being able to reposition to a better, higher value asset compared to if you repositioned in a hot market with more capital gains tax implications. Of course, everyone is different, and so there's simply no easy answer for investors facing cash flow issues. But the main takeaway is to really try to actively improve your cash flows first. And if that's not possible, then consider repositioning into stronger investments before just cutting your losses and your real estate exposure. Rental income, cash flows, and appreciation might be compressed right now, but in the long run, fundamentals for real estate have not changed. Once interest rates come back down a bit, your cash flows should improve, and the combination of higher immigration and lower housing supply growth in Canada will give you good growth prospects in the long run for real estate price growth too. We're a real estate sales brokerage focused on helping people with real estate investing in Toronto. And we're here to help you buy, sell, and optimize your Toronto real estate investment portfolios. If you need help to review your existing situation to see how you can improve it, just book a free discovery call with us by heading to this link right here. If you enjoyed this video and found it helpful, we would love your support. Give us a thumbs up and hit that subscribe button to stay tuned for more awesome content from us. Our channel is all about real estate investing in Toronto, covering everything from market trends, housing policies, to interest rates, to best investing strategies. We're here to make your real estate investing journey easier for you, and so our team offers services like planning, analysis, buying, selling, renovating, finding tenants, and even property management. If you want to learn more, just check us out on our website or find us on social media. Thanks so much for watching, and I'll see you in the next video. Bye.